So I think what's happening in the labour market, churn in the labour market.
By the way, lovely to see you.
Nice to see you
Yeah,
too.
sorry.
Yeah,
My manners.
so churn in the labour market slowing down. So everyone has a midlife crisis during the pandemic.
Yes, we did, didn't we, Paul?
And everyone goes off and decides to do other jobs and so on. And that's coming to an end. And that's very clear in the JOLTS data. So you're seeing a bit more stability. Now that does matter, because the longer you stay with an employer, the more productive you're likely to be.
I've been here 25 years, it's still not working.
31 years at UBS. I must tell Sergio. So you end up with that improvement in productivity. And that, of course, helps with things like wage costs. We are also seeing a slowdown in wage growth. Wage growth is moderating. And then there's one or two slightly concerning trends that are emerging in the details. So things like the fact that more and more people are taking on multiple jobs, which is a signal of strain probably for lower income households. So basically, yes, if you're middle income, life's looking pretty good, but actually there are one or two slightly warning signs in the details.
I hear you, and again, it's always nuanced, isn't it? But look, I was interested in something that not too many people looked at yesterday. I know you would have done, and this is the household net worth survey as well. And I thought it was fascinating. Get a load of this. Americans' net worth rose $4.8 trillion in the fourth quarter to $156 trillion. That is a new record high. Now, it's a lot about whether you own the stock market and whether you own a property as well. But with Americans keeping their jobs, great, it's 3.7%. I'm pleased they're keeping their jobs. And their household net worth going up quite dramatically as well. No wonder that the economy isn't creaking as much as people thought it would as well. Well, any thoughts about the wealth of Americans, the amount of people who are keeping their jobs, and what that means for inflation?
So on the wealth side, we've got to remember about half of Americans don't own equity. So the exposure to the equity market is very skewed. Housing is more generally owned. And again, if you're a homeowner, life is pretty good, because your inflation rate, if you're a homeowner in the States, is below 2%. So you've actually got rising real incomes, you've got rising asset prices, you're in a fairly good spot. And that does support. This is why we've never believed in the recession scenario. We've always had this soft landing story, because the middle income consumer is going to be supportive, generally speaking. But what is also true is they're not off to the races, because the thing about wealth is it only matters to inflation if you reduce your wealth, if you're going in and breaking open the piggy bank and rushing out to spend. And what's generally happening is that with wealth, American households are reducing their monthly savings rate. You've got $5,000 in the bank, you cut back on the monthly savings rate, but they're not dipping in to that $5,000 in the bank, unless it's a really important expense like a Taylor Swift concert ticket, obviously, the vitals.
I
know you're a massive Swiftie.
I've become one. It's the truth.
I want to bring up a couple of figures. The PC, 2.4%, the unemployment rate, 3.7%. What further evidence does Powell need to decide that a rate cut is coming?
So he doesn't need any further evidence. Possibly he needs an economics textbook, but he doesn't need further evidence. We're in a situation...
Which economic textbook does he need?
So we're in a situation where I think the thing is, if the Fed does nothing, and this is the point, if the Fed does nothing, it is tightening policy, because inflation is going to continue to drop. Not with the speed that it dropped last year, obviously, but it's coming down. So if the Fed does nothing, real inflation-adjusted interest rates are going up. And we don't want that. But what I think we've got is a situation where the Fed, and for that matter the ECB, are going to follow inflation down. As we just heard from Mester, they want to be able to draw a straight line through 3 data points that are going downwards, then they'll cut rates. So I don't think that they naturally need more evidence, but for a political fig leaf of cover, they're going to want first quarter inflation drops, second quarter you cut rates. That's going to be the narrative, I think.